Understanding leading indicators, a guide for economists, investors, and businesses. Leading indicators are essential economic tools that provide insights into future economic activity. By analyzing these indicators, stakeholders like businesses, investors, and policymakers can make informed decisions that may affect their operations, investments, or strategies. Understanding the nuances of leading indicators, their function, examples, and how they relate to other types of indicators can greatly enhance one's economic foresight and planning. What are leading indicators? A leading indicator is a measurable data set that can forecast future economic movements. By identifying potential shifts in the economy before they occur, leading indicators help businesses and investors prepare for changes that could affect markets and operational strategies. Some key characteristics of leading indicators include predictive capability, they signal future movements in economic trends. Timeliness, they can alert analysts and decision-makers to changes ahead of actual economic shifts. Measurability, they are quantifiable and can be tracked over time. Leading indicators fall under one of three main categories of economic indicators, the others being lagging indicators, metrics that confirm past trends, and coincident indicators, which reflect current economic activity. Types of economic indicators. 1. Leading indicators, predict future trends. 2. Lagging indicators, confirm trends after they occur. 3. Coincident indicators, reflect the current state of the economy. Importance of leading indicators. Understanding leading indicators is crucial for several reasons. Strategic planning, they allow businesses to anticipate market conditions, enabling proactive strategy adjustments. Investment decisions, investors utilize leading indicators to adjust portfolios and manage risk based on expected market shifts. Policy formulation, policymakers use these indicators to design monetary and fiscal policies that can mitigate potential economic downturns or capitalize on growth opportunities. Common examples of leading indicators. There are numerous leading indicators, each providing unique insights into various sectors of the economy. Here are some of the most significant examples. 1. Purchasing Managers' Index, PMI. The PMI reflects trends in both the manufacturing and service sectors, signaling potential growth or contraction in the economy based on changes in material demand. A PMI above 50 indicates economic expansion, while below 50 suggests contraction. 2. Durable goods orders. This monthly survey from the U.S. Census Bureau measures the quantity of new orders placed with domestic manufacturers for delivery of durable goods. Increases in durable goods orders generally indicate future economic growth, as they reflect business investment in long-term assets. 3. Consumer Confidence Index, CCI. The CCI surveys consumers' perceptions of the economic landscape and their personal financial situation. High consumer confidence typically signals increased consumer spending, which drives economic growth. 4. Jobless claims. Weekly jobless claims data from the U.S. Labor Department provide insights into labor market conditions. Rising claims suggest economic weakness, while declines can indicate economic strength and potential hiring increases. 5. Yield curve. The yield curve tracks the relationship between interest rates for different maturities of government bonds, particularly the difference between short-term and long-term yields. A flattening or inverted yield curve often signals an impending recession. Challenges of leading indicators. Despite their potential, leading indicators come with inherent challenges. Accuracy. Leading indicators are not foolproof, their predictive ability can vary widely. Conflicting signals. Different indicators may provide conflicting information, making it essential to analyze multiple indicators in conjunction. Time lag. Some indicators may provide advanced warning but may lack precision regarding timing and magnitude. Leading indicators versus lagging indicators. To fully grasp the concept of leading indicators, it's essential to understand their distinction from lagging indicators. Leading indicators. Predictive nature, anticipate future economic conditions. User base, favored by economists, analysts, and investors for strategy formulation. Data type, based on anticipatory metrics linked to various sectors. Lagging indicators. Confirmative role, reflect past economic performance. User base, used to validate economic trends. Data type, based on solid metrics and historical data. Resources for tracking leading indicators. Accessing accurate and timely data on leading indicators is vital for effective analysis. Key resources include: the Conference Board publishes the Consumer Confidence Index and Leading Economic Index. U.S. Department of Labor releases jobless claims and employment statistics. U.S. Census Bureau provides data on durable goods orders and other economic surveys. Conclusion: leading indicators serve as valuable tools for forecasting economic shifts and are crucial for informed decision-making among economists, investors, and businesses. While they have uncertainties and limitations, analyzing a spectrum of leading indicators alongside other economic data can enhance predictions about future economic health. Despite their predictive limitations, when harnessed correctly, leading indicators can significantly influence success in strategic planning and investment decisions. Understanding these economic signals and integrating them into analysis can pave the way for better preparedness in an ever-changing economic landscape.